By issuing Treasury bonds. Investors purchase these bonds. The government receives cash immediately and pledges to repay it, along with interest, over 10, 20, or 30 years. And critically, those bonds are tradable. If you acquire a 10-year Treasury bond today, you can sell it tomorrow to someone else. There's a colossal secondary market for these instruments. This inherent liquidity is precisely what entices investors to lend to the government. And it's exactly what Cosimo de' Medici meticulously created in Florence in 1427. The Federal Reserve is a direct descendant of Medici central banking. The Fed, crucially, doesn't serve individual depositors. It doesn't hold your personal savings account. It is, in essence, the bank for banks. Commercial banks maintain their reserves at the Federal. The Fed lends to these banks when they require liquidity. The Fed dictates the money supply primarily by adjusting interest rates and engaging in the buying or selling of government bonds. This is precisely what the Medici Bank accomplished for European governments. It was the central, indispensable node in the European financial network. It lent to governments and powerful institutions, thereby controlling credit conditions across the entire continent. The Federal Reserve was established in 1913, but its fundamental model was perfected by the Medici as early as 1450. Even the IRS employs a system akin to Medici tax farming. In medieval Florence and across Renaissance Europe, governments seldom managed their own tax collection. Instead, they auctioned off the lucrative right to collect taxes to private individuals or banks. The Medici, for example, might pay the government a fixed sum, say 100,000 florins, upfront for the right to collect taxes from a certain region. They would then proceed to collect perhaps 120,000 florins in actual taxes, pocketing the 20,000 florin difference as pure profit. This lucrative practice was known as tax farming. The Medici understood this profound truth in 1434, and astonishingly, the fundamental system remains unchanged today. Let me now connect Medici innovations directly to the specific modern financial mechanisms that shape your daily life. Your mortgage is a direct descendant of fractional reserve banking. When you borrow $300,000 to purchase a house, the bank isn't holding £300,000 in a physical vault somewhere. They simply create that money through the act of issuing you a loan. You sign a promissory note, and they credit your account with $300,000. That money literally did not exist before that moment. The bank created it. And now you owe them $300,000 plus interest over 30 years. You will, over 3 decades, likely repay around $500,000 in total for that initial $300,000 loan. The bank has effectively generated $200,000 from money it literally conjured into existence. This is the very essence of the Medici system. Your credit card is a modern letter of credit. In the 1400s, if you were a merchant journeying from Florence to Venice, carrying large sums of gold was inherently perilous. So, the Medici would provide you with a letter of credit, a document stating you could withdraw up to 500 florins from their Venice branch. You would travel with a piece of paper instead of precious gold. Upon reaching Venice, you'd present the letter and withdraw precisely what you needed. Today, your credit card functions identically. It's a virtual letter from your bank, authorizing merchants to extend you credit up to a certain limit. You travel without physical cash. You purchase items with a promise to pay, and the credit card company will, in turn, levy a hefty 18% to 25% interest on any outstanding balances. Same system, simply different technology. Government bonds, which fund the U.S. deficit, are distinctly Medici designed. The U.S. government, for instance, faces a projected $2.4 trillion annual deficit in 2026. How does it finance this colossal sum? Cosimo, however, masterfully controlled every single election. How did he achieve this? Through a sophisticated blend of debt and patronage. Florence had approximately 5,000 wealthy citizens who were eligible to vote and hold public office. Cosimo had extended loans to at least 3,000 of these prominent citizens. Some were directly indebted to the Medici Bank for their business ventures. Others had borrowed extensively to maintain their lavish estates. Still others had family members securely employed within the expansive Medici network. When election time came, Cosimo would subtly make his preferences known for whom he desired to be elected. And the 3,000 men who owed him money would invariably cast their votes as instructed. Because if you didn't vote the way Cosimo wanted, your loans might be abruptly called in early. Your crucial line of credit might be reduced. Your son might suddenly lose his lucrative position at a Medici-affiliated business. Cosimo never resorted to overt threats. He simply didn't have to. The threat was subtly, yet powerfully, implicit within the very fabric of the debt relationship. If you owe someone money, you typically do what they want. This was power wielded through sheer financial leverage, and it proved far more effective than ruling through brute force. Because those controlled by debt often harbor the illusion of freedom. They believe they elected their own leaders. They lived in a republic. They weren't subjects of a king. Yet, every single leader they elected was someone Cosimo had personally approved. This is the identical mechanism by which modern financial institutions continue to control governments today. When a country owes the IMF or the World Bank billions in debt, that country complies with the IMF's demands, austerity measures, privatization, specific economic policies. Not because the IMF possesses an army, but because the threat of cutting off vital credit is worse than any military threat. The money thus circulated efficiently within the expansive Medici network. And here lies the crucial insight. The Medici never physically transported 500,000 gold ekus from Lyon to Paris or London. They simply updated their meticulously kept ledgers. The Paris branch owed the Lyon branch 100,000 ekus. The London branch owed Paris 50,000 ekus. At the end of the accounting period, they would net out all transactions, moving only the essential difference in physical gold. This is precisely how modern central banks operate. The Federal Reserve, for instance, doesn't physically move trillions of dollars when it conducts monetary policy. It updates electronic ledgers, effectively creating money by changing numbers in computers. The Medici achieved the very same feat 6 centuries ago, using handwritten ledgers and letters of credit. And because they were the bankers for all the major European powers, they could dictate who received credit and, critically, who did not. If the King of France sought a loan, but the Medici disapproved of his war, they could simply refuse. Without credit, the king couldn't fight. The Medici required no standing armies. They exerted their control over European geopolitics purely through the strategic allocation of credit. Now, let me reveal how this intricate system enabled the Medici to seize political control of Florence without ever formally holding official office. In 1434, Cosimo de' Medici made a triumphant return to Florence following a brief period of exile. He had been, truthfully, accused of leveraging the bank's immense wealth to corrupt the city's government. Yet, Cosimo was simply too powerful to remain in exile. Within a year, he was back. And for the next 30 years, until his death in 1464, Cosimo governed Florence as an unofficial, yet absolute, dictator. He never claimed the title of duke, prince, or king. Officially, Florence retained the facade of a republic, complete with elected councils and magistrates. These investors can, in turn, sell their bonds to other investors at any time. There's a colossal secondary market. This inherent liquidity is precisely what entices investors to lend to the government, thereby funding the U.S.'s vast national debt, a system Cosimo de' Medici conceived and implemented in Florence in the 1420s. But the Medici were far from finished. Their third innovation was the one that truly bestowed upon them ultimate power, becoming the central bank for all of Europe. By 1450, the Medici Bank wasn't merely the Pope's bank. It was the banker to the King of France, the Duke of Milan, the King of England. Indeed, virtually every major European ruler entrusted their finances to the Medici. This granted them something unprecedented, the unparalleled ability to control the money supply for entire nations. Here's how it worked. Imagine the King of France, determined to fund a war against England. He needs 500,000 gold ekus instantly, but tax revenues, however, were months away from collection. He approaches the Medici Bank in Lyon, requesting a substantial loan. The Medici agree, but with stringent conditions. The interest rate is a steep 12%. The loan must be repaid within 2 years. And as collateral, the king pledged the entire tax revenue from 3 of his wealthiest provinces. Should he default, the Medici gained the right to collect those taxes directly. The king agreed. He had, in essence, no alternative, for he urgently needed the money. The Medici would then create the loan, not by physically transferring 500,000 gold ecus, but by issuing a letter of credit. This document formally stated that the king was authorized to draw up to 500,000 ecus from any Medici branch across Europe. The king would then utilize these credits to pay his soldiers, procure weapons, and finance his war. The recipients of these payments, in turn, would deposit them in Medici branches or use them to settle debts. These were known as forced loans or pre-stands. Your contribution was mandated based on your wealth, and refusal could mean exile or far graver consequences. Now, forced loans had existed for centuries, but they carried a significant drawback. Once you lent money to the government, your capital became irrevocably tied up for years on end until the government repaid you. You couldn't access it, couldn't utilize it. Your funds were essentially immobilized. The astute Medici, however, perceived a remarkable opportunity. What if, mused Cosimo de' Medici, Giovanni's astute son, who took over the bank in 1429, these government loans could be freely traded amongst individuals? Cosimo de' Medici, leveraging his bank's influence, created a vibrant market for these loans. If you held a government bond promising repayment in 10 years with 5% annual interest, Cosimo would purchase it from you at a discount. He might pay you, for example, 80 florins for a 100 florin bond. You, the original lender, received immediate cash. Cosimo, or the Medici Bank, secured a guaranteed 5% return, augmented by the profit derived from purchasing the bond at a discount. This pivotal innovation brought into existence the world's inaugural bond market. Government debt was thus transmuted into a freely tradable asset. The implications of this innovation were nothing short of monumental. Governments could now borrow virtually limitless sums. They no longer needed to concern themselves with immobilizing the capital of wealthy citizens, as those citizens could simply sell their bonds to the Medici Bank or other astute investors, thereby regaining their liquidity. The government secured its crucial funding. The original lenders gained vital liquidity, and the Medici acquired a highly profitable investment with assured returns. This mechanism is precisely how the modern bond market operates. The U.S. government issues Treasury bonds, which investors buy. The initial 100 florins in deposits, through these iterative rounds of lending, effectively transmuted into nearly 900 florins in total loans. The Medici had, in essence, conjured 800 florins into existence from nothing more than ledgers. Crucially, as long as a run on the bank didn't occur, meaning not everyone demanded their deposits simultaneously, the system operated flawlessly. And here lies the sheer genius. The Medici were earning 8% interest on 900 florins in loans, but were only paying, perhaps, 3% interest on the original 100 florins in deposits. They were generating profit from money that, in its physical form, simply didn't exist. This is the essence of fractional reserve banking, and it is precisely how modern banks operate. Consider your own bank account. When you deposit, say, $10,000 into your checking account, your bank keeps perhaps $1,000 in reserve and lends out the remaining $9,000 to other customers. Those borrowers spend the money, which then gets deposited elsewhere, and that bank lends out 90% of it again. The original $10,000 thereby multiplies into approximately $90,000 in total loans across the entire banking system. Thus, money itself is fundamentally created through the act of lending, a system the Medici pioneered in the 1400s. However, fractional reserve banking was merely their first groundbreaking innovation. Their second was even more potent, transforming government debt into a marketable asset. By 1427, Florence found itself embroiled in a costly war with Milan. Wars, as ever, were ruinously expensive, and the government urgently required money immediately, though tax revenues trickled in slowly over the course of the year. So Florence did what governments always do. They borrowed. They compelled its wealthiest citizens, including the burgeoning Medici family, to lend funds to the state. Noble families yearned for influential church positions for their offspring. Consequently, everyone required access to the vital credit and sophisticated financial services that only the Medici could command. By 1420, the Medici Bank had established branches in Rome, Venice, Naples, Milan, Geneva, Lyon, Avignon, Bruges, and London. They were, in essence, the world's first truly international banking conglomerate. And they leveraged this expansive network to forge a system that had never existed before. They possessed the unprecedented ability to create money seemingly out of thin air. This was the core mechanism that fundamentally changed everything: fractional reserve banking. Allow me to illustrate precisely how it functioned, as this remains the identical system your bank employs today. Here's the fundamental concept. A merchant in Florence deposits 100 gold florins with the Medici Bank for safekeeping. The Medici provide him with a receipt confirming his entitlement to withdraw 100 florins at any moment. Now, the Medici knew from long experience that rarely do all depositors demand their funds simultaneously. On any given day, perhaps only 10% of depositors would seek to withdraw their money. So, the Medici would maintain a reserve of 10 florins in their vaults to cover these expected withdrawals. But what of the remaining 90 florins? They would judiciously lend out the remainder. For instance, they might lend 90 florins to a merchant bound for Venice, charging an annual interest rate of 8%. This is where the true ingenuity unfolds. That merchant takes the 90 florins, purchases goods in Florence, and the seller, in turn, deposits the 90 florins back into the Medici Bank. The Medici now possess an additional 90 florins on deposit. They keep 9 florins, 10%, in reserve and lend out the remaining 81 florins. The new borrower spends these 81 florins. The recipient deposits that sum, and the Medici then lend out 73 florins. This cycle continues relentlessly. This was the sophisticated banking world that Giovanni di Bicci de' Medici, born in 1360, entered. Giovanni commenced his career apprenticing with a distant relative who managed a bank in Rome. He rapidly mastered the business, learning the complex art of moving money across Europe using bills of exchange. He became proficient in maintaining accounts using the new double-entry bookkeeping system, which was rapidly gaining traction throughout Italy. And, most significantly, he discerned that the true lucrative path lay not in lending to mere merchants, but in securing the colossal business of the church. In 1397, Giovanni returned to Florence and inaugurated his own bank with a strikingly straightforward strategy: become the Pope's personal banker. At that time, although based in Rome, the Pope's financial operations spanned the entirety of Europe. The Church collected tithes, essentially taxes levied on Christian believers from every parish in every country. This vast sum of money required secure transport from local parishes across Europe all the way to Rome. It had to be meticulously counted, accurately recorded, and diligently safeguarded. Furthermore, the Church constantly needed credit to finance ambitious construction projects, military campaigns, and the exorbitant lifestyle of the papal court. Giovanni promptly offered his comprehensive services. He would expertly manage the Church's complex finances, efficiently move money from Paris to Rome without the perilous and expensive physical transport of gold, and provide crucial credit whenever the Pope required it. In exchange, he would receive a modest, yet immensely profitable, percentage of every transaction. The Pope agreed, and with that pivotal agreement, Giovanni di Bicci de' Medici became undoubtedly the most influential banker in Europe. For once you are the Pope's banker, everyone else across the continent suddenly needs you too. Monarchs across Europe sought to remain in the Pope's favor. The family's reign ended, yet their systemic legacy achieved immortality. In the next few moments, I will meticulously detail exactly how one influential family in Renaissance Florence invented every financial mechanism that governs your life today. We will explore why debt, rather than armies, represents the supreme form of power, how the Medici system disseminated from one Italian city to envelop the entire world, and why you are ultimately unable to escape it, even if you desired to, because this system has become the very scaffolding of civilization itself. Let us commence at the genesis, for truly comprehending how Giovanni di Bicci de' Medici ascended from a modest banker to the founder of an enduring financial dynasty necessitates an understanding of the banking landscape in 1397. In medieval Europe, the Catholic Church officially prohibited the charging of interest on loans, a practice known as usury. The Bible declared it a sin, thereby precluding most Christians from engaging in money lending. Yet, economies inherently required credit. Merchants needed loans to finance ambitious trade expeditions, and nobles required funds to maintain their extensive estates. Consequently, Jews, unrestricted by Catholic doctrine, naturally assumed the role of Europe's primary money lenders. However, an ingenious workaround existed. While you couldn't charge direct interest on a loan, you could levy fees for currency exchange, for transferring money between distant cities, for the safeguarding of deposits, and you could accept gifts made in gratitude for loans, which were not technically considered interest. Italian bankers, particularly those in Florence and Venice, honed their expertise in navigating these intricate financial ambiguities. They developed elaborate systems involving bills of exchange and letters of credit, which effectively functioned as loans while deftly sidestepping the church's strictures against interest. Not because they threatened you with soldiers, but because they wielded something far more terrifying: financial destruction. The Medici, in essence, invented the very system you find yourself constrained by today. This includes fractional reserve banking, a system enabling banks to lend money they technically don't possess. Government bonds, transforming national debt into a marketable, tradable asset. Central banking, where a single institution commands the money supply for entire nations. Letters of credit, the direct ancestor of your modern credit card. Double-entry bookkeeping, the rigorous accounting system that meticulously tracks every financial movement. Tax farming, a practice where private entities collected government revenue in exchange for a substantial commission. Every single one of these fundamental mechanisms, every one of these systems that continues to control your financial life today, was either conceived or perfected by the Medici family in Florence between 1397 and 1494. And here lies the most significant revelation. The Medici Bank ultimately faltered in 1494. The family's power waned, and their empire crumbled. But the sophisticated financial system they had engineered did not collapse with them. Instead, it spread, first to Venice, then to Genoa, to Amsterdam, to London, and eventually to New York, permeating every country on earth. Today, you cannot purchase a house without engaging with the Medici design principle of fractional reserve banking. You cannot utilize a credit card without recourse to a Medici-conceived letter of credit. Your government cannot fund its deficits without issuing Medici-designed bonds. The Federal Reserve itself is, in essence, a Medici-designed central bank. Global financial giants like J.P. Morgan Chase, Goldman Sachs, and Bank of America all operate on systems painstakingly built by the Medici 6 centuries ago. In 1397, within the bustling city of Florence, a man named Giovanni de' Medici established a bank. It was a modest operation, consisting merely of a counting house situated on the Via Porta Rossa, staffed by a handful of employees diligently maintaining ledgers and processing transactions for local merchants. There was nothing outwardly remarkable about it, nothing to suggest that this nascent institution would, in time, profoundly alter the course of human civilization. However, Giovanni made one pivotal decision that would indeed reshape human history. He chose to lend money, not to merchants or traders or local businesses, but to the Pope, the revered head of the Catholic Church and the spiritual sovereign of all Christian Europe. And when the Pope becomes your debtor, the dynamic of power fundamentally shifts. For when you control the Pope's finances, you effectively control the Catholic Church. When you control the Church, you command the kings and emperors who desperately rely on the Church's blessings for legitimacy and power. When you control the kings, you control Europe. And when you control Europe, you possess the means to construct a financial system so potent, so deeply entrenched in the very structure of civilization, that 6 centuries later, every person on earth remains living within its pervasive influence. The Medici family ultimately ruled Florence for nearly 300 years. Yet, what truly distinguishes them from every other ruling dynasty in history is this critical fact: they never held official power. They were never crowned kings, never enthroned as emperors, and for most of their extensive reign, they were not even elected officials. They governed Florence, and eventually much of Europe, through a singular mechanism far more potent than armies or noble titles: debt. They judiciously lent money to everyone who mattered. And when you owed the Medici Bank money, you inherently complied with the Medici's wishes. The government secured its revenue immediately, without the administrative burden and associated costs. Taxpayers, regrettably, often bore a heavier burden, as tax farmers were inherently incentivized to maximize their collections. Today, while the IRS is technically a government agency, the underlying mechanism bears a striking resemblance. The government effectively outsources tax collection to an agency that is clearly incentivized to maximize revenue. The IRS collects approximately $4.7 trillion in annual revenue and is often rewarded with budget increases linked to its collection performance. The Medici themselves would recognize this system instantly.